Hello, everyone. I'm Tara Rice, Head of Secretariat for the Committee on Payments and Market Infrastructures at the Bank for International Settlements. It is my pleasure to welcome you to Day 2 of the BIS Conference on Regulating Big Tech. Today's session focuses on big tech, competition, and privacy in the digital age. Yesterday, we discussed policy issues around big techs and financial stability, competition, and data protection. What is clear is that policy issues and coordination in these areas are critical at both the domestic and international level. Today's session benefits from a great lineup of speakers, including central bank governors and leading policymakers and scholars. Their valuable perspectives will enrich and inform our discussion on how to harness big tech's potential while mitigating risks. And so it is my distinct honor and privilege to introduce today's keynote speaker, Dr. Yi Gang, Governor of the People's Bank of China and Deputy Director of the Financial Stability and Development Committee of the State Council. Governor Yi is also a distinguished member of the Board of Directors of the BIS. Today, he will talk about China's experience with regulating big tech, drawing on policy actions taken by the PBOC and other authorities on financial regulation, antitrust, and data protection. Governor Yi, we look forward to your insights. The floor is yours.
Thank you, Augustine, for inviting me. I'm glad to participate in the BIS conference on regulating big tech and share with you some of my observations about China's experience in regulating big tech. First, technical advance help promote fintech development in China. In recent years, new technology such as AI, big data, cloud computing, distributed ledger, and also e-commerce have been increasingly integrated into financial services and accelerate financial innovation. New forms of business have emerged, such as mobile payment, fintech credit, and robo-advice. China hosts about 1 billion netizens, which lays a solid foundation for adoption of fintech. Among the top 20 platform companies in the world at the end of 2020, 5 are from China. Financial innovations promote the development of fintech and reduce cost of financial services. Big tech entry into payment business help accelerate development of mobile payment, whose penetration rate reached 86% in China. With widespread application of QR code, merchants do not need purchase payment terminals, thus significantly reduce transaction costs. China mobile and online payment fee is less than 0.6%. User can also enjoy customized financial products when making electronic payment. Fintech help improve efficiency and financial services. Some Chinese big tech are among the first to create a smart mechanism to guarantee that seller can get the proceeds and the buyers get their purchased goods, which promotes online consumption. Online retail sale reached 12 trillion renminbi, up 11% on a year-on-year basis. Some big tech provide internet-based consumer credit and loan for individuals running small business. Some use big data to get a fuller picture of borrowers and a more accurate estimate of probability of default, thus improving efficiency of financial activities while keeping the probability of default at a lower level. Fintech can also promote financial inclusion. Because of low marginal cost, fintech companies can serve underserved customers that are not covered by traditional banks. Empowered by digital technologies, the whole procedure of credit approval and risk control can become digital, making collateral requirements less necessary. As a result, the financial needs of small and micro business are better served, as they usually borrow a small amount but need the money urgently. At the end of July this year, the number of small and micro business with loans from Chinese banks has reached over 38 million. Microloan for poverty relief total more than 710 billion renminbi and are generally sustainable. Second, fintech development creates new regulatory challenges. First, some fintech companies conducted unlicensed financial business. Top platform companies in China have acquired massive data from users through e-commerce, payment, and search engine services regarding consumers' identity, accounts, transactions, consumption, and social relations. These firms then analyze the user's creditworthiness and cooperated with the financial institution in the name of supporting lending activities. This actually constitutes personal credit information business, but conducted without relevant permission. Some platform companies provided wealth management, credit, and insurance services on the same platform, increasing the possibility of cross-product and cross-sector risk contagion. Second, non-compliance in payment business deserves attention. In the past, non-bank payment service providers affiliated to platform companies could directly link with hundreds of commercial banks and open accounts with them, making settlement finality a serious issue and could cause systemic risks. Platform companies invested funds of customers' payment reserve in various financial assets. They also misled customers by listing credit product include quasi-credit line as payment options. Third, monopoly has toppled a level playing field. The winner-takes-all nature of platform companies could lead to market monopoly and compromise innovation efficiency. Some platform companies seize market share through cross-subsidy and adopted anti-competition policies after gaining a dominant position. The anti-competition practice, including block competitors from entering their platform to provide services and making barcode payment only available to apps of the same company group. Fourth, personal privacy and information security is threatened. Chinese consumers usually need to surrender personal information in exchange for financial services of platform companies. Excessive collection or even abuse of consumer information hurt consumers' information security and privacy. Fifth, platform companies also pose challenge to banking industry. On the one hand, Chinese banks traditionally have the advantage in outlets, consumer information, and funding sources have been increasingly challenged. The rapid development of innovative online financial products has diverted banks' deposits. On the other hand, there are about 4,000 small and medium-sized banks in China. With limited resources, small and medium-sized banks have no choices but to rely on platform companies for technology to perform consumer relations, credit analysis, and risk control. This could undermine their competitiveness and the ability to gain customers. Third, China's regulatory response to challenges of big tech companies. To address the above challenges, China has continued to fill regulatory gaps and take measures with a view to level the playing field. In this process, we have the following 2 points. First, we have continued to strengthening policy transparency and predictability, protect property rights and intellectual property rights, protect consumers' privacy, and promote fair competition. Second, following the market-oriented and law-based approach that is also in line with international norm, we endeavor to create a sound business environment, promote higher level opening up, and strengthen international cooperation. The purpose of the measures are threefold. First, financial activity must be licensed to operate. Second, firewalls should be set up to avoid spread of financial risks across sector and industries. Third, improper connection between financial information and the commercial information should be cut off to prevent the data network financial activity loop. Some measures can be summarized as cutting the direct link. On payment business, in 2016, the People's Bank of China required non-bank payment service providers to cut direct links with commercial banks and to conduct clearing services via legitimate clearing institutions. This is the first cutting the direct link. From the end of last year, non-bank payment service providers were required not to list consumers' credit product as payment options. This is the second cutting the direct link. We will earnestly implement the measures to strengthen regulation of payment business going forward. On the front of prudential regulation, we established the financial holding company management system in September 2020. Platform companies that carry out financial business are required to set up financial holding companies and to bring all subsidiaries engaged in financial activities under the umbrella of the holding company. This would help separate financial business from technology services. In some sense, also a kind of cutting the direct link. Going forward, we ask a financial holding company to consolidate their balance sheet and strengthen prudential regulation. Financial business must be conducted by licensed entities. Platform companies with conducting financial activities should follow the principle of same business, same rules. Recently, the People's Bank of China has asked a platform company to carve out personal credit information business and to provide credit information services to financial institutions through licensed credit information agencies. That is to cut the direct link between personal credit services with financial institutions. This could help break information monopoly and promote information sharing. Going forward, we will continue to improve rule of law and ask all financial services, such as personal information business, to be licensed. On strengthening anti-monopoly and promoting fair competition. To address unfair competition in payment sector, we ask platform companies to give consumers more choices in payment method, which would help create space for small and medium enterprises. Going forward, we will continue to cooperate with anti-monopoly authorities to curb monopoly and actively deal with algorithm discrimination and other new forms of anti-competition behaviors. On protection of data and consumer rights and interests. Since 2016, China has issued cyber security law and data security law and the personal information protection law to address irregularities in information collection. Financial institutions are urged to collect, use, and store information in strict accordance with the principle of lawful and minimum necessary in order to protect personal privacy and the rights of consumers. To know how their data is collected and used. The People's Bank of China recently issued the administration guideline for the credit information business, which regulates the credit information industry. Going forward, we will explore to define data ownership in more accurate manner, facilitate data transactions, and promote fair use of data in the premises of safeguarding personal privacy and data security. In conclusion, the booming digital economy has a far-reaching impact on economic and social development, way of productions, people's daily life, and global governance. In the era of digital economy, the integration between finance and technology is a global trend. as technology for good is an intrinsic requirement, how to enhance innovation capacity while preventing negative effects of fintech is a common challenge faced by us all. We are willing to participate in international rules making related to digitalization. We are also willing to strengthen cooperation with international organizations such as BIS and other jurisdictions on anti-monopoly financial regulation and data protection to mitigate regulatory arbitrage and cross-border contagion of financial risk. Thank you very much.